Hello, welcome to this recording on the module FIN3701. This is part of the online classroom, and in this class, I'm going to be taking you through the second assignment for the module FIN3701. Now, the second assignment due on the 3rd of October, as you can see here, is broken down into 4 key questions. It consists of 4 questions. The first question, let me just go up. The first question just touches on trying to compare different capital structures. And it's based on study unit 7 from the study guide. And then question 2 is based on the residual policy of dividends, which is a very common policy to be asked in this module, and it's based on study unit 8. Question 3 touches on dividend payment using other methods than a cash dividend. It talks about a share dividend and a share split, and it's also based on study unit 8. And then lastly, question 4. Question 4 is based on comparing leases versus purchasing, which is touching on study unit 9. So I'm going to take you through this assignment. Something important to note is I take you through this assignment. I'm taking you through this assignment assuming that you've already gone through all the classes up until the last class as part of the online classroom. So I'm assuming that I'm taking you through this assignment as someone who's managed to go through all the material. So you're not seeing the concepts that I'll be touching on for the first time. So I won't be going into as much detail as I go through in the online classroom when I teach you this for the first time, but I will be taking you through this with a lot of detail. But I'm assuming that you've gone through the online classroom classes up until the last class, meaning you've been able to cover study unit 7, study unit 8, and study unit 9. So question 1 says, Nelson Company has made forecast of sales with associated probabilities of occurrence in the table below. So there's a 20% chance there'll be sales worth 200,000, 60% chance sales will be worth 300,000, 20% chance they'll be worth 400,000. The company has fixed operating costs of 100,000 per year, while the variable operating costs represent 30% of sales. The existing capital structure consists of 250,000 ordinary shares that have a 10 Rand per share book value. No other capital items are issued. The marketplace has assigned the following required returns to risky earnings per share. So if we calculate the coefficient of variation for the earnings per share, these different coefficient of variation values, they correspond to these required returns. So if the company has a coefficient of variation of earnings per share of 0.43, it means the required return will be 15% and so forth. So remember from your previous studies, if you still remember, FIN3601, the coefficient of variation, is equal to the standard deviation. It's equal to the standard deviation of returns divided by the expected return. Okay, if you still remember your earlier studies, you touched on this in FIN2601, but for most of you, it might have been some years back. But the coefficient of variation is simply the standard deviation of returns over the expected return. So in this case, it will actually be the standard deviation of the EPS, since we're dealing with earnings per share, divided by the expected EPS. We won't be dealing with the expected return, we'll be dealing with the expected EPS. and we won't be dealing with the standard deviation of return. We'll be dealing with the standard deviation of EPS. Okay, right. And then the question goes on to say the company is contemplating shifting its capital structure by subtracting debt for ordinary shares. So the company only has ordinary shares, but they want to shift some of their ordinary shares to go to debt, shifting its capital structure by subtracting debt for ordinary. I think this is actually supposed to say by adding debt for ordinary shares. So they want to actually place debt in place of ordinary shares. This was worded incorrectly. So the three different debt ratios under consideration are shown along with an estimate of each ratio of the corresponding required interest rate on all debt in the following table. So this table is telling us that the company is considering three possible debt ratios. So far, they only have equity, but they're considering introducing 20% debt or 40% debt or 60% debt. If they introduce 20% debt in their capital structure, the interest rate on debt will be 10%. 40% debt in their capital structure, interest rate on debt will be 12%. 60% debt in their capital structure, interest rate on debt will be 14%. Something important to note is that the more debt, the more debt you add, as you can see, the higher the debt ratio, the higher the interest on debt. Because what happens is you add more and more debt, you get higher financial risk, right? As you add more and more debt, you get higher financial risk, meaning there's a risk that if business is poor, you might end up having to pay high interest rates. It's like you've borrowed a lot. So if you keep borrowing, investors will require more and more interest on the money that you're borrowing because you'll have higher financial risk. Financial risk is the risk that you borrow money and then you are unable to pay finance costs. So it's just important to know this. It could be asked in the exam. It wasn't asked here, but it could be asked in an assignment or in an exam. The more debt you have, the more money you borrow as a company, the higher the interest on the debt will be. So you'll notice that if the company actually goes to a 60% debt ratio, they have to pay an interest of 14% on their debt. If they go to a 40% debt ratio, they pay an interest of 12%. 20% debt ratio is only 10%. Okay. So now we can look at the questions. The first question says, calculate the expected earnings per share, the standard deviation of the earnings per share, and the coefficient of variation of earnings per share for the three proposed capital structures. Okay. So there are three proposed capital structures here, and we have to calculate the earnings per share, the standard deviation of earnings per share, and the coefficient of variation of earnings per share under each proposed capital structure. So the first thing we need to do, we need to look at each capital structure independently. You look at the 20% debt ratio structure by itself, calculate the earnings per share, calculate the expected earnings per share, calculate the standard deviation of the earnings per share, and then calculate the coefficient of variation of the earnings per share. Then you do the same for the 40% debt ratio separately. And lastly, you do the same for the 60% debt ratio. So let's look at how we would do this for the 20% debt ratio. So for the 20% debt ratio, the first thing we're going to do, we calculate our total capital. Currently, we are told we've got 25,000 ordinary shares, and each ordinary share has a book value of 10 Rand per share. So we're told we only have equity. Right now, we only have ordinary shares in our capital structure. So we take the number of shares multiplied by the book value per share, and that gives us 250,000 Rand, which is our total capital. And then 20% of this 250,000 is debt. So we say 20% times 250,000, and that gives us 50,000. So this is for now, we only have equity. So if we're going to introduce 20% debt into our capital structure, it means this 250,000 Rand, which is only equity, 20% of it is going to be debt. So we say 20% of 250,000 and we get 50,000. So it means the debt we have in our capital structure is now going to be worth 50,000 Rand. And then we were told that the interest, when we have a 20% debt ratio, we were told that the interest rate that's charged on our debt is 10%. So we then multiply this debt, this new debt amount in our capital structure, which is 20% of the total capital. We multiply it by 10%, and then that gives us the interest rate that we're going to get on debt when we use a 20% debt ratio. And then lastly, we calculate the number of shares. If this 250,000, 20% of it is going to be debt, it means 80% of it is going to be equity, because we are still going to maintain this 250,000, but we're going to divide it 20% debt and 80% equity. So 80% of 250,000 will give us the number of ordinary shares. In this case, that will be 200,000. And then we'll say 200,000 divided by 10, giving us 20,000 ordinary shares. So after we've introduced 20% debt into our capital structure, we're going to be left with 20,000 ordinary shares. Right. And then whenever you're dealing with capital structures, that's always the starting point. Try to determine what your current total capital is, and then split that capital by the new debt ratio. Usually you'll be told that the total capital is remaining the same. And then also just calculate the interest on the debt which has now been issued, and also calculate the number of shares which will now be outstanding based on the new debt ratio, right? After doing that, we can now create our income statement. You'll notice that the examples that I used in the online classroom didn't have percentages or even examples in past assignments. So this example is a bit different. It's not like the examples that you usually come across, but it is talked about in the prescribed textbook. So in this case, once we've determined the debt and the interest on the debt and the number of shares outstanding after issuing debt, we can now look at our earnings per share under each of the given possible levels of sales. Remember, we were told that there's a 20% chance that our sales will be 200,000, 60% chance that our sales will be 300,000, 20% chance that our sales will be 400,000, right? So we now recreate the income statement, but we look at the income statement under each of the probabilities. So at 20% probability, we were told we have 200,000 in sales, 60% we were told we have 300,000 in sales, and also 20% we were told we have 400,000 in sales. So we put those sales. Then we subtract our variable operating costs, which we were told are 30% of sales. So we find 30% of this amount, 30% of this amount, 30% of this amount, and that gives us our variable operating costs. And then we were told that our fixed costs are 100,000. So we also subtract these fixed operating costs, and then that gives us our operating profit, which is also known as the EBIT, 40,000, 110, 180. Then we subtract our interest expense. So you see, if you've calculated your interest expense before, it makes life easier for you. You now just subtract the interest expense that you will have calculated before in those calculations I showed you. If you subtract your interest expense, you then get your earnings before tax, which is 35,105,175. If you subtract your tax at 28%, remember, if you make an operating profit, If these values are positive, it means you'll have a tax expense. That's why my values are in brackets. But if you had gotten an earnings before tax which was negative, let's say any of these values was negative, then you would add your tax. Always check for that and always remember that. If you get positive profit, like earnings before tax, if it's positive, or even if your EBIT is positive, in the case of operating cash flows, we deal with EBIT, but when we're dealing with capital structure, we put interest expense, right? I do talk about that in the online classes. But anyway, the key thing is anytime before you calculate tax, look at what you're taxing. If what you're taxing is negative, meaning it's a loss, you need to add tax. But if what you're taxing is positive, meaning you made a profit, you subtract tax. It's a common mistake students make, so you always need to look out for that. And then after subtracting the tax, we are then left with our net profit. So these are the net profit amounts. Net profit under 20% when our sales are 200,000. Net profit after under 60% when our net profit is 75,600 and our sales are 300,000. Net profit under 20% when our sales are 400,000, giving us 126,000. And then we divide this net profit by the number of shares. Remember, we calculated the number of shares right here, which is now 20,000. Those are the new number of shares outstanding, and we get 1.26, 3.78, and 6.30. Please remember, like I said before, it's always best to do these calculations right at the beginning. If you do that, it makes everything easier for you. It means you have everything you need to be able to help you with the calculation. Okay, so that's the first part. So I've shown you how to calculate the earnings per share. Now we want to calculate the expected earnings per share. Now with the expected earnings per share, you're using part of your knowledge from earlier studies, FIN3701 again. We've been given probabilities. We've calculated the earnings per share under each of the probabilities. Under the 20%, 60%, and 20% probabilities, we get these earnings per share, 1.26, 3.78, and 6.30. And then remember, when you want to get an expected value, you might remember this from FIN3701. You take each probability and you multiply it by the EPS or the return or whatever value you've been given right here. Remember, if you want an expected EPS, we used to deal with expected returns in FIN3701, but I'll just say expected EPS. EPS is taking the place of the return right here. To get your expected EPS, you take each probability multiplied by each EPS, and then you add the values up. This is the formula. Sum the product of each probability and the EPS and add them up. So how do we do this? We say 0.20 multiplied by 1.26 plus 0.60 multiplied by 3.78 plus 0.2 multiplied by 0.20 multiplied by 6.30, and then we get 3.78. Okay, so rather than doing it in this way of writing numbers, I just said 0.2 times 1.26, and then I got 0.25. I said 0.6 times 3.78, then I got 2.27. I said 0.2 times 6.3, then I got 1.26. You add these numbers up, you get 3.78. So that's the expected EPS. And then after that, you can calculate the standard deviation of the EPS. We always start by getting the variance, and then the square root of the variance gives us the standard deviation, right? So how do we calculate the standard deviation of the EPS? We take each probability we've been given, we put each EPS that we obtained, and then we use this formula. This is also another formula from FIN3701. The formula says to get the variance, we take each probability multiplied by each EPS minus the expected DPS squared, and then we add the answers up. So in other words, we are going to say 0.2 multiplied by 1.26 minus 3.78 squared plus, so that will give us this 1.27. This 1.27 will come from this calculation, plus 0.60 times 3.78 minus 3.78 squared. That will give us this 0. And then lastly, this 1.27, we get it by saying 0.20 times 6.30 minus 3.78 squared. And then if we add those values up, we get the variance. And then the square root of that variance gives us the standard deviation of 1.59. And then lastly, we can then calculate the coefficient of variation by simply taking our standard deviation of 1.59 divided by the expected DPS of 3.78, and then rounded off to 2 decimal places, we get 0.42. Okay, so that calculation that I just did under the 20% debt, you would then repeat it exactly as it is under the 40% debt. 40% times 250, you get the debt. 12% times 100,000, where 12% is coming from right here. You get the interest expense, number of shares outstanding. If debt is 40% interest, the shares outstanding are 60% times 250 divided by 10, which is 15,000 shares. Recreate your income statement, 20%, 60%, 20%, get your EPS. Calculate your expected DPS based on these new earnings per shares that we just calculated. Calculate the standard deviation of the EPS by first getting the variance of the EPS, and then you get the standard deviation of the EPS, exactly like what I did before. Divide the standard deviation by the expected EPS. So we then do that lastly again for the 60% debt ratio, exactly the same. And we get 0.5, 10.16, and 3.19. Okay. Part 1.2 said, determine the optimal capital structure, assuming 1, maximizing of earnings per share, and 2, assuming maximizing of share value. So we're asked to determine the capital structure if we are assuming maximizing of earnings per share, and if we're assuming maximizing of share value. Okay. So if we are using maximizing of earnings per share, we simply just look at each of our expected DPS, and then we pick the capital structure that gives us the highest expected DPS. And from the values that we calculated, we can clearly see that the 60% debt ratio capital structure gives us the highest expected earnings per share of 6.41, right? 6.41. The other capital structures, for example, the 40% debt ratio gives us 4.70, whereas the 20% debt ratio just gives us 3.78. So in this case, we pick the 60% debt ratio, which gives us 6.41 if we're maximizing EPS, because that's the highest EPS from the capital structures. However, if we want to maximize share value, we use this very important formula that I talk about in the online classroom, whereby we take the earnings per share divided by the required return. We take each earnings per share divided by each required return, right, to give us the price of the share, right? So we do have our expected DPS. We calculated these, but the problem now is that we don't have the required returns. So with regards to the required returns, we actually have to to use this table right here. We have to look at each of the coefficients of variation values that we calculated. And then we have to find the coefficients of variation values which are closest to each of these. And then we take our required return to be each of those values. So the formula we have to use in this case to calculate the price is simply the expected earnings per share divided by the required return. So under the 20% debt ratio, we calculated the coefficient of variation to be 0.42. So if we come to this table to find the required return to use, we look here under coefficient of variation of EPS, and then we can see the closest coefficient of variation to 0.42 is 0.43. Therefore, we use 15% as our required return. So you'll find that for the first calculation of the share price, we took 3.78 divided by 0.15, right? We took the expected EPS divided by the corresponding required return for our coefficient of variation of 0.42. For the 40% debt ratio, we look at the coefficient of variation, which is 0.45. We come here again. The closest to 0.45, since we are moving up, we round up to 0.47, and we take a required return of 16%. Obviously, we can't use 15% again because we used it for 0.43, we used it for 0.42, right? And obviously, because the coefficient of variation is higher under 40% debt, we would expect the required return to be higher. So if we look at 0.45, the closest coefficient of variation from this table is 0.47. So we take 16%. So you'll find that we said 4.70 divided by 0.16. And then lastly, for the 60% debt ratio, the last coefficient of variation we calculated was 0.50. If we come here, the closest one is 17%. So we take our expected DPS divided by 0.5, divided by 0.17, 6.14 divided by 0.17, and then we get 37.7, right? So these are the share prices under each proposed capital structure. So if we want to maximize share value, we pick the capital structure that gives us the highest price. And clearly here we can see that the 60% debt ratio gives us the highest price again. So we would pick the 60% debt ratio capital structure one more time again to maximize share value. And then lastly, part 1.3 said, construct a graph showing the relationship in part 1.2. Note you will probably have to sketch the lines because you have only 3 data points. Okay. Now, a lot of students struggle with graphs. A lot of students struggle with drawing graphs. But when you're drawing graphs, the key is just make sure you try to use as much of the paper, as much of an A4 page as possible, and just try to make sure you get your scales right. If you do that, the graph won't be too difficult to draw. So in this case, for part 1.3, we have to draw a graph showing the debt ratio against each of the expected EPS values. And then also we need to draw a graph showing the debt ratio against each of the share prices. So what I did, I used Excel to draw the graphs, but in the exam, obviously, you might not have Excel. So what you can do, you can use 1 centimeter. You can use 1 centimeter to represent an earnings per share for each price. So for example, 1 from 0 to 1, it would be 1 centimeter. You just use your ruler. To 2, another centimeter, 3 centimeters, 4 centimeters, 5, 6, 7. You can even use a scale of 2 centimeters, whereby 2 centimeters is from 0 to 1, and then another 2 centimeters is from 1 to 2, another 2 centimeters from 2 to 3, another 2 centimeters from 3 to 4, 2 centimeters from 4 to 5, 2 centimeters from 5 to 6, and 2 centimeters from 6 to 7, right? And then for this side, for the debt ratio, since there are only 3 values, the less values you have, the greater your scale can be. You can use 5 centimeters. 5 centimeters from 0 to 20, and then a further 5 centimeters from 20 to 40, and then another 5 centimeters from 40 to 60. And then we want to draw the graph based on our earnings per share, our expected earnings per share. The first expected earnings per share was 3.78 with a 20% debt ratio, right? So what you can do, you can take your ruler if you're drawing, and then you can go from 20, you go up, and then you have 3.78, I think, this side, then you move across, then you put an X there. So your first X will represent 20% and 3.78, right? And then you can move on to, it's 4.70 at 40% debt, 4.70 at 40% debt. You would go to 4.70, which is somewhere there, then you move across, and then 40% debt, which is somewhere there, then you would put an X. And then lastly, it's 60% debt corresponding with 6.41, 6.41, and 60% debt. So 6.41 is a bit higher. It's not up on the screen now, but you would go to wherever 6.41 is. And here we have 60% debt. So we would probably need to just move the screen a bit higher. Okay. This one, let me put this. 6.41 would be somewhere there. Bringing our X there. Let me just move the screen down a bit. Yeah. Sorry, it's only that my graph, but you get what I mean, right? With the last one, you would just move from 6.41, you would move across to get to 40% debt ratio, right? You would move to from 6.41 to get to the 40% debt ratio, like right here. Then you would put an X. So there would be 3 X's that you would put, and then you would join your lines to get the graph, okay? And then you would do the same under the share price. The idea is to just get the scale right. If you get your scale right, you'll be okay. We have 3 possible share prices, so you would need to account for those 3 possible share prices in your graph, just to make sure that your graph comes out properly. So you would just have to make sure you get the prices right, but you would just use that same approach that I just explained to you. So the 3 prices to consider would be 25.2, 29.38, and 37.7. So as you can see here, these prices are all between 20 and 40. So ideally, you could have your scale from just 20 to 40, but you could also do what I did here. Let me just offer a suggestion. What you could do, for example, from 5 to 10, you could make that 2 centimeters, 10 to 15, 2 centimeters, 15 to 20, 2 centimeters, and so forth. So you could make these gaps 2 centimeters, and then these could be 5 centimeters again. And then you could just take your first share price and 20% debt ratio, and then they should cross there. And then your second share price with the 40% debt ratio, then they should cross there. Then your last share price, I think it's 37.70, and 40% debt ratio, and they should cross there. Then you just join That's how I got that line. That's how Excel did it. Then you join and you will have your graph. So I know a lot of students just panic as soon as they see graphs, but graphs are not difficult. They are not difficult at all. You just don't need to panic. You just need to make sure you get your scales right. And then you just join the value on the vertical axis and horizontal axis, put a dot, the next value, put a dot, the last value, and then you just join them in a straight line. In this module, you tend to not draw graphs, you just draw straight line graphs. You don't draw graphs with curves, so you don't have to worry too much. Okay, so that was question 1. It's a bit of a long question. As you can see, it has 25 marks, so I hope you could follow that. Next, we can look at question 2. Question 2 is a bit easier. I'm sure I won't spend too much time here. And I touch a lot of this in the online classroom. Question 2 says, ready company's optimal capital structure calls for 20% debt and 80% equity. The interest rate on debt is constant at 11%. Its cost of ordinary shares funding from retained earnings is 13%. The marginal tax rate is 28%. And the company has the following investment opportunities. So the company can invest in 4 possible projects: Project Graph, Project X axis, Project Y axis, Project Z axis. The cost of the first project is 34,000, second 36,000, 40,000, 44,000. And then we're given a number of internal rates of return. And then we're told that the company is expected to have a net income of 70,000. And the company bases its dividends on the residual policy of dividends. Okay. And then firstly, which projects should Ready Company choose? Justify your answer. 1.2, how much would Ready Company pay in dividends after accepting all profitable projects if it follows the residual theory of dividends? And then lastly, calculate the company's payout and retention ratio. This is supposed to say Ready Company's payout and retention ratio. I think it's a mistake. They're saying torrent. Okay. Whenever you're dealing with these questions to do with deciding which projects to invest in, you need to compare your internal rates of return with the weighted average cost of capital. So your starting point, as I talk about in the online classroom, your starting point should be to calculate the weighted average cost of capital. And then you can compare the weighted average cost of capital with each of the internal rates of returns you've been given. Okay, so we calculate our weighted average cost of capital. We take the debt ratio, which is the weight of debt, multiplied by the cost of debt before tax, multiplied by 1 minus the tax rate, right? Plus the weight of equity times the cost of equity. Remember, if you have 20% debt, then it means you have 80% equity. They haven't said anything about preference shares here, so we just assume that we're just dealing with our debt and our equity. So it's just equity in all, which is ordinary equity. They haven't said anything about preference shares. And then we get our weighted average cost of capital of 11.98%. Be sure to always check that you have an after-tax or before-tax cost of debt. If it's before tax, you multiply by 1 minus the tax rate. If it's after-tax cost of debt, there's no need for you to multiply. Okay. So this was the interest rate on debt. It's the before-tax cost of debt, hence we multiplied. And then after that, we calculate the breakpoint of equity. You always have to be careful when you get a weighted average cost of capital value. You just have to calculate your breakpoint of equity just to be sure which total level of investment your weighted average cost of capital applies to. So the breakpoint of equity acts as a guide. It tells us that this 11.98% only works up to a total investment of 87,500. If we go to a total investment which is more than 87,500, then this weighted average cost of capital will no longer be valid for us to make investment decisions because the cost of ordinary equity will go up. So to get the breakpoint of equity, we take our retained earnings divided by the weight of equity. Your retained earnings is this net income that they've talked about, and we divide by 0.80. Retained earnings divided by weight of equity. So the work above applies as long as the total investment is less than 11.98%. So as long as the total investment is less than 87,500. As soon as the total investment goes above 87,500, the cost of equity is going to go up from 13% to the new cost of equity. And it means we won't be able to use this WACC anymore to make investment decisions. After that, we create this table right here. It's always an important table when you're trying to decide which projects to invest in. This table is known as the investment opportunity schedule. It's known as the investment opportunity schedule. And we put our projects. We have 4 projects. We rank our projects based on the internal rate of return from the highest to the lowest. Project Z as the highest IRR, followed by Project Y, Project X, and Project Graph. We also put the cost of each project. We've been given these costs, 44, 40, 36,000, and 34. And then we find the cumulative investment, the total investment in each of these projects. So if we invest in Project Z only, we will spend 44,000. If we invest in Project Z and Y, we will spend 44,000 plus 40,000, giving us 84,000. If we invest in Project Z, Y, and X, we will spend 44,000 plus 40,000 plus 36,000, giving us 120,000. If we invest in Project Z, Y, X, and Graph, it means our total investment will be 44,000 plus 40,000 plus 36,000 plus 34,000, giving us a total investment of 154,000. Okay. So it's important to put these total investments because they tell us that our weighted average cost of capital will only apply as long as the total investment is less than 87,500. So it means that this work that we calculated, if we invest in Z, Y, and X, our total investment will be 120. So we can't use this work to make decisions. Likewise, if we invest in Z, Y, X, and Graph, our total investment will be 154, which is more than 87,500. So we can't use that work to make investment decisions. But anyway, we don't have to worry about that also, because we find that when we get to Graph, to Project X and Project Graph, the IRR values are less than the weighted average cost of capital. Only Project Z and Y have internal rates of return which are greater than the weighted average cost of capital. So that means we can only accept Project Z and Project Y. But even if, this is really important, it wasn't the case here, but even if we had obtained an IRR year, which was greater than 11.98%, we would still write no, because our cumulative investment is more than the breakpoint of equity. We would need to know the new cost of equity. We would need to know the new cost of equity to be able to get the correct WACC to compare these internal rates of return with. We can't compare these internal rates of return with 11.98% because once we spend more than 87,500, we've reached the break point of equity. So it means we need to calculate a new WACC that we can then use to compare with these internal rates of return to be able to decide whether or not to invest in the projects. But in this case, we didn't have to worry about that We were just given the weighted average cost of capital for retained earnings. They didn't say anything about the weighted average cost of capital for new ordinary shares. I talk a lot about that in the online classroom, so we don't have to worry about that. And we've seen that only projects Z and Y have IRRs greater than the WACC, and their total investment is less than 87,500. Part 1.2 says, how much would Ready Company pay in dividends after accepting all profitable projects if it follows the residual theory of dividends, right? So if you follow the residual theory of dividends, our total investment will be 84,000, and then 80% of this will be financed with equity, because we were told that the company has an optimal capital structure of 20% debt and 80% equity. So it means 80% of this investment will be financed from equity, right? So we say 80% of 84,000 and we get 67,200. So this would be the equity required. And then this equity will be paid from net income. So we'll take our net income minus the equity required, and then that will give us the amount that's left for dividends. So it means the company will have 2,800 that it can pay out as dividends. So that's the answer for part 1.2. Remember, the residual theory of dividends says if you have retained earnings, you first use those retained earnings to finance the equity that you require for any capital expenditure. And then the retained earnings or the net income that's left after financing equity is what you pay out as dividends. And then lastly, you're asked to calculate the payout ratio and the retention ratio. These are just two very simple formulas. The payout ratio is the proportion of your net income you pay out as dividends. It's simply dividends over net income. We get 0.004. And then the retention ratio is simply 1 minus the payout ratio, which gives us 0.96. These two values, you can write them as percentages. You can write that your payout ratio is 4%. You might find from past solutions, they write these as percentages, or you can also write it as 96% for the retention ratio. Okay. So I think what I'm going to do, I'll divide this class into two parts. So the first part, I took you through the first two questions to assignment 2. I took you through question number 1 and question number 2. So I'll now stop the first part of the class. And then in the second part of the class, I'll take you through question number 3 and question number 4. So thank you very much for listening. I hope the first part has been helpful. You can follow up with the second part of the class to look at question number 3 and question number 4. I just don't want to make one class that's too long. I prefer to break them down into two parts. So please continue going through the assignment in the second class. So I'll stop the first part of the class going through assignment 2 for FIN3701 right here.